stocks, business, and real estate. So actually, you have skill sets. That could be a communication skill. It could be a painting skill. It could be a cooking skill. It could be coding skills. Whatever your skills are, it's you. So you have been blessed with an asset, your body, yourself. You are an asset. So think about yourself. You are an asset. So the first asset that you do invest is yourself. And then you actually multiply that investment in yourself through assets, through real estate, through stocks, through business. That's what something that we're going to talk about. So before you invest, make sure that you have an investment. We're using the savings challenge. Actually, I teach people to save 25% of their monthly income. So if you're making about $2,000 a month, you should be saving $500 at least. But for most people, maybe they haven't started saving. So saving is really the first part. After you save some money, you invest it. Actually, the point of investing is to make that money grow and not sit in a piggy bank. And that's something that we normally always discuss. People think that businesses and 10x movements are actually just out of the blue. Even Elon Musk said all that he achieved in life was made from hard work, working 16 hours a day, 7 days a week, 52 weeks in a year, and yet people still call me lucky. So why do you want to become rich as fuck as so you can travel the world? Buy real estate everywhere, wherever you want. Spend time with your family. Help those who are struggling. Stop listening to a boss if you have an annoying boss, and eat the finest food if you can. So these are your goals. And of course, people are not expected to have a business first. Your 9 to 5 is a tool, so use it to build your investments, your experience, your connections, your portfolio, self-education, and future. Just by watching this channel, you are actually educating yourself. So thank you for spending time with us. And imagine yourself in 2030. You own a house already with a large garden. You have a family. You're spending time growing crops together. You've got a nice sized gym. You are spending time working out, you and your family together. You're going out with your family on vacations to the places you want to visit. Imagine that so that you can actually do the hard work of saving and investing in the next 10 years. Okay. So when you're going through an awesome 10x journey, there are times when you are bearish in a stock temporarily. While you believe that the stock will go up 10x, like your $10 is going to go $1,000 or $100, it could actually have a temporary decline. Do you have to sell that stock, or what should you do? The first thing that you should do is, if you have 100 shares of that stock, we teach people to sell call options. That is a covered call. When you're selling a call option, it's also called option writing. You are receiving cash upfront. When you receive $1 times 100, that's $100, and you're receiving that upfront, it actually gets added into your cash. When the expiry date happens, if the underlying asset never goes beyond the strike price, that cash that you receive is yours. Why is it yours? Because the asset is below the strike price. Let's say the asset is 100 shares of Apple. Let's say Apple strike price, you sell a call at $180. Apple is currently 136. So you believe that Apple is not going to hit $180 within the next 2 months. Today is July. Let's say it's the September. So August and September. By September 30, Apple is not going to go up 20% or 30% at $180. I'm going to sell a call on Apple, which is 1 share. The call option is the right to buy Apple at 180. What happens if Apple does not break above 180? That call option expires worthless. Whatever you got from selling calls on Apple at 180 strike is gone. So all of those premium is yours. So let's say you got a $500 premium, like let's say $10. $10 from a 180 Apple strike. $10 times 100 shares is $1,000. You just paid yourself $1,000. And you're not obliged to give the shares of Apple upon strike if Apple is still below 180. That's how it is. So you're taking money. So that money that you are underwriting, you're an underwriter because you're selling a call option, is a risk for you if Apple goes above 180. It depends upon the strike price that you ask for. Let's say currently Apple is 136. If you get a strike price of $140, let's say that's very near today, so 140. If Apple manages to go 141 on the strike date, let's say the date is July 30, 2021, this month, what do I have to do? It's 141. It's above. You sold a call. Let's say you got $10, but the current price of Apple is 141 on that end of the date. You have to deliver 100 shares. So if you don't have shares, you have to buy it from the market, and the market is 141. 141, you buy the shares, and then that is given to the person, but you got $10. So 141 minus 10, your actual cost is 131. So net, you're still up. So as long as the strike price plus the premium that you got, because the premium is what you got, as long as Apple was never 150, you're still in the money. Okay? So 140 plus 10, technically speaking, your break-even cost is 150 because you got a $10 premium on your option. Now, what does it mean? Option buyers have a limited risk. It's the extent of the premium paid. Whenever you sell a call option, somebody else is buying that call option. Somebody is paying you the right to sell it to them, or to in that case, since you sold it, you are delivering the shares to them, 100 shares per contract. So let's say you sold a call option, Apple again, at $140 strike price. You are obliged to give him 100 shares of Apple at $140 within that strike date. Actually, we're talking mostly about European call option, so it's not an American call option. It has to be on that same date. Meaning, even if Apple goes 145 or 146 or 135, it doesn't matter. What matters is that date. If we talked July 30, 2021, it's a European call option, then the only thing that matters is that date. So on that day, European option, July 30, 2021, if Apple share price is 145, let's say, so I'm obliged to give him 140. But since this person, the option buyer, gave me $10, so this person already gave me $1,000, 10 times 100, because one contract is 100 shares. Even if he's technically up because it's 145, right? 145 minus 140, he made $5. He actually paid me $10. So plus 10, he minus 10 plus 5, so he's actually minus 5. I'm still up 5. Now, the option seller has a limited profit. Yes, I collected $10. Even if tomorrow the premium could go $12 or $15, it depends on how far I am from the strike price. I cannot make more gains. If I accepted $10, I just accepted $1,000, and that's it. 10 times 100 shares, that is just all the money that I make. The premium I receive is just that. Technically, if the option buyer who paid $10, that option price will move up. Why will it move up? Because Apple goes from 140 to 170, let's say. So within that time frame, let's say within a month, let's say Apple indeed went up, his $10 could have gone $30, and I would have lost because I accepted $10 only. Now, why is it considered a loss? It is considered a loss if I don't have shares of Apple to begin with. But if I have shares, what does it mean? I'm just obliged to give the shares to him at 140. Let's assume I have Apple as low as $110. I'm willing to give my shares at 140, net gain of $30 plus the $10 premium. I'm already up $40, sorry, 110 plus 140. 140 minus 110 is $30 profit plus the $10 premium I got. Because I'm happy already for my $40 gain, I don't need to make $80 or $70, etc. So the only loss that I've made was the opportunity to make money. I never really lost money because I made a sell call in a covered position, meaning I have 100 shares to deliver. So when I explain to people selling calls, I always tell them, sell a call if it's covered, if you have 100 shares. If you don't have 100 shares of that stock, you can never do that. So there are questions. Can we sell calls on warrants? The answer is, as far as I know, you cannot. I know that the sell call option is only something. So there's no such thing as a sell call on a long call, because warrants by definition is already, so people ask me about warrants. Warrants are long-term call options. It's already an option. Warrants are the option to buy the stock at 11.5. That stock is usually a special purpose acquisition company. So you're paying, let's say, $1 to own, let's say, SVSV. Let's say you bought the warrants, SVSV. You buy 1,000 shares of SVSV warrant. That gives you, that $1,000 that you paid for gives you the right to own, as far as I know, it's 100 shares for, I know that it's 100 shares typically, so the options, they will give you the, like the number. So let's say for that 1,000 shares, I think you can buy, I think it's times 3, eh? So $3,000 worth of SV at 11.5. So you can buy about 300 shares at 11.5 with your $1,000 SV warrants. So you have to check the prospectus. How much does one warrant, if I have 1,000 warrants, how many shares of stock can I buy? I think it's usually 1:3 or 1:5. Just check the prospectus. But that means that I could buy let's say 1,000 shares, I can buy 3,000 shares of SVSV, which is Aero Farms. I'll do that because I'm long-term on Aero Farms. Now, how do I manage my risk if I have that long option on Aero Farms? You can technically sell a call option on those Aero Farm shares if you exercise the warrants. However, the warrants are exercisable 2025, 2023, 2027. So technically speaking, if we're talking about today only, you cannot do sell call options on your warrants. You can only sell call options on your stocks, as far as I know, because you haven't exercised your call options yet. You haven't exercised your warrants to buy the shares yet. That's what I mean. Okay, so why are we discussing sell call options? It's because the market went V-shaped. So we all know that since May, the market has bottomed. We were talking about it. We were saying Christmas shopping list in May 7. And we gave our buy recommendations. And we were saying the market has bottomed May 14, May 21. We were saying that the market sustainability of rally is going to go further. And we were right. So we held on, and so far, for instance, BYD, if you've bought 140 to 160, you're up roughly 70% in just a matter of May, June, July, or 3 months. So within that 2 to 3 month time span, you're thinking today, even if BYD goes from 240 or 220 to 280, another 20% higher, what you want to do is lock in my gain. I don't want to lose my gains. I'm okay to lose further gains. So the normal person would just do something as easy as selling shares. That's one way. That's the lousy way. Because the lousy way of selling all of your shares is wrong, especially if you think that BYD is going to go $500 next year. Because chances are, if you are long-term, you wouldn't sell all of your shares, because are you sure that it will fall back to 185? Since you're not sure that it will go 185 or 140, and how about the people who have BYD as low as 100? You don't expect them to sell all of their shares because they think that it's a long-term 10x. Just like what we do, we save money for the 10x moves, not for the next year move. So the right thing to do there is just sell a call option at 260 or 280. The perceived resistance is where you sell your strike price. The price that you think you're willing to sell, not the actual price today. The actual price of BYD is 220. You have 100 shares of BYD. What will you do? Sell a call option at 280 within, let's say, end of July or end of August or end of September. Meaning within the next 3 months, if BYD happens to go to 280, you're going to give your shares. And in response, because you're giving your shares to them, you are expected to receive money today. Sample, a BYD 280, what is the required limit price that we want to sell a call option on BYD? At least 5%. $14 is okay. If it's a 280, what is 5%? It's 14. You want to sell as high as you can. If somebody's willing to pay you $28, that's even better. Now think of it on the other side. Why is somebody paying you $14 or $28 for the option to buy BYD at 280? Perhaps they are very bullish, more bullish than you. Perhaps they like BYD cars because BYD is also supplying to Apple, right? They're supplying the batteries to Apple. And they also are dominating the robo-taxi as well in Shenzhen, in China. So they have also charging stations. They've got a vertical integration. They are the test of China. So there are many people who have reasons to be bullish. This is why $60 went to $280 within a year span. Nonetheless, even if you're bullish, we tell you to sell a call because you're not obliged to give your shares unless it's $280 anyway, which is something that you want to get a share price sell anyway. And let's say it never goes to 80. What happens? You just pocket that difference. What's that difference? The premium. If you accepted $10, you got it. If you accepted $14, you got it already. You're just sacrificing further gains. You're not sacrificing your current gain. So that's what you like. Now, what happens if BYD goes from 220 to 185? What happens there is that the sell call options expire worthless, but your stock, since you own 100 shares, technically, yes, you have that drawdown, 220 to 180. That means you lost about $40. If you only receive $20 from your premiums, the ones you collected, you got $20, but then you suffered a $40 drawdown. Technically, it mitigates the loss, right? You're only selling calls because even if BYD falls 180, what will you do? You probably will buy more shares of BYD at 185 because the sell call is worthless. You have what? 20. Let's say 20 times 100, you've got $2,000. What will you do with that $2,000? You're going to buy BYD. The premiums you got is supposed to buy BYD at 185 if it ever happens. So why are you even thinking that the stock price will fall? You only sell a call when you think that the stock price is toppish, when you think that the stock price is prone to profit taking. Now, why do you think that the stock price like BYD is prone to profit taking? Because it has been going up for constant speed in the last 2 months, specifically 72% in the last 2 months. If BYD didn't rise 70 or 80%, we wouldn't be talking about sell call options to begin with. Only because there is a strong run up and we want to just protect our gains. Now, of course, at the risk of protecting your gains, as I said, if it goes to 80, you are obliged to give the shares. What if it went to 350? You are still obliged to give 280. Remember that. It is locking a gain, it is giving your shares away, but you're also getting paid. So it's a win-win scenario if you ask me. Geely Auto, let's take a look. From about nearing 18 to as high as 27, more than 50%. I will only sell a call option if the stock has gone up more than 50% from its current lows, and if I will only sell a call option if I really like the shares to begin with. Meaning, I am so scared that BYD or 1211 or Geely will never go back to 18. If my cost is $20 and I think that it's not going to go $20 anyway, or if it goes down to 20, I'm willing to buy it anyway because I really like the company long term, my sell call option is simply my way to mitigate the drawdown. Because example, if the price was at 26 and I was willing to sell call on Geely at $30, for instance, I would have gotten a premium because it's now 23. It's not 30. That call option premium will decay worthless, meaning my $1,000 is mine. I'm not obliged to give my 100 shares of Geely at 30. Why do you think I'm not going to give or oblige my shares to give at 30? Because the person who bought the call option will never exercise it. They'll only exercise the Geely call options if Geely is actually above 30, right? So remember that when you're selling a call option, the strike price has to be at a price that you're willing to sell. Usually, of course, you will sell the price nearing the resistances. You saw the resistance at 36, you're okay to sell at 30, it's fine. Maybe some people would even try to sell a call option at 36. However, the premiums that you get if it's now, let's say you want to sell a call at 30 and right now it's 23, the premiums that you're getting is smaller and smaller because you are because 30 minus 23 is $7. You're far away from the current price. Versus example, if the price was 26 and you try to sell a call option at 30 because it's $4 away, usually there will be people who would believe and give you a higher premium for that. So when you're selling a call, what should you do? You sell a call on an up day. You sell a call on a green day. You sell a call when the stock is green. Not necessarily the market is up. It's possible that the market is down, but the stock is up. So even if the market is down, but the stock is up, you sell a call option when the stock is up. Because usually you get a better premium on the stock, on the call options when you sell it. Because your incentive to sell a call option is to get the highest price. You want to sell at the highest price. That's why you want to sell on a green day. Sell a call option when the stock price is surging 20%, 50%, 70%, and so forth. That's why you can never do a sell call option when the stock price is very low. You only sell a call option when the stock price is very high. I'll give you an example, XPeng. XPeng rallied 100%. Yes, we like it long term. Again, these Chinese vehicles are doing a lot of listings and a lot of racing. Let's say you really want to sell XPeng at $45, but you don't want to sell all of the shares. So what should you do? Should you sell half of your shares of XPeng at 45? Let's say your cost is below 32. But you know that XPeng is not going to go back to 32. So you're in a dilemma wherein I think that XPeng is going to go $100, but in the next 2 months, maybe XPeng is not going to go beyond $60. So why is it $60 that you're thinking about the strike price? Because that was near the highs of 2021. The February, January highs were somewhere in the $60 zone and the $48, $50 zone. So you're thinking that maybe these high prices are perhaps the target that I have for the year. Just for the year 2021, not 2022, not 2023. So for 2021, what you want to do is sell a 60 strike for XPeng. If you have 100 shares of XPeng, or even sell at a 50 strike, let's say 50 strike because it's nearer to the 43 area, take the premium, let's say you get a $5 premium or even a $2.50, like 5% is fine. So 50 times 5% is $2.50. You take your $2.50 or $250. Supposedly, the $250 is your cushion in case, so let's say $2.50, in case XPeng goes from 43.66 down the way to 38. It falls 38, you lose $5, but diba, the stock price goes down. Let's say you have 100 shares, it goes down 38. What happens? You got $250, right? What will you do with your $250 collected profit? You will perhaps buy XPeng. Those $250, you'll probably buy it at 38 or 32. Again, what am I saying? The call option will expire worthless. So the $250 that you got is supposedly to buy the same shares of XPeng at a lower price. What happens if XPeng does not fall? XPeng goes 50 and even 55. What should you do? You have no choice. You have 100 shares of XPeng, you give those shares at $50. The beautiful thing is that you got $2.50 anyway, so the actual sell price that you did was even better. 50 plus 2.5. So win-win scenario, right? The only loss that you make is if you do not have the shares. Let's say you were stupid enough to sell a call of XPeng at 50 thinking, maybe the top of XPeng is 50. But you don't have 100 shares. You are taking a risk. If XPeng happens to be 55 and you only got $2.50, your real sell price is 52.5. You lost $2.50. When you buy the shares back at 55, you lost at $250 with your stupidity. So, remember, when you're selling a call, you have to be owning 100 shares. Nikki, what if I only have 10 shares of XPeng? Can I do it? No, you can't. I'm sorry. Sometimes your options are so small when you don't have 100 shares of XPeng. So that's it. Let's give you more ideas. NIO. So you're seeing all these Chinese electric vehicles gone up 70, 80, 100% from its lows. So again, we only sell a call when the stock has had a huge run up and we have an ability to think that, okay, maybe it could fall. So since it could fall 10 to 20% after significant run up, I should perhaps sell a call. Again, where should you sell your strike price? You cannot sell a strike price of $50 because most likely if you make a sell call at $50, it could get called unless you want your 100 shares of NEO to get called anyway, which is fine. Let's say you sell call at 50 and then by July 30, NEO is 50.9. What are you supposed to do? Give your shares at 50. So 100 shares given at 50. Supposedly, you'll do that if and only if NEO strike price of sell call 50 is giving you a premium of, let's say, $2.50. So technically, you're still selling it at 52.5 rather than 50.9 today. So check those options because those options are gonna give you money with or without the stock price going down. But preferably, I'll tell you what, my style is, and what I teach is sell a call above the price. If the current price is 50, you want to sell a call at 56 or $63 or maybe $55 and then take a premium. Whether the premium is $1 or $2, take it because anyway, you have the shares of NEO to begin with. So sometimes people don't know call options. That's why we tell them how to do it. What you're doing is essentially a covered call. So we're going to keep on repeating it. Li Auto, 126%. Okay, most of the Awesome 10X don't have Li Auto. So here's what you could do. Let's say you are super bearish because this one went up 126%. You want to take a risk. Your risk is actually unlimited. Be careful. If you sell a call on Li Auto at 45, let's say, and Li Auto manages to break 45 next month, July 30, let's say the strike price is 45. You take, let's say, $500. So you got a premium. Okay. You got a premium. Let's say not 45, but 40. You sold as a call at 40. You got a $5 premium. So 40 plus 5. So your actual break-even price is Li Auto should not be above 45. Here's what I want you to do. From July 2 to July 30, if you're selling a call, you're naked. Let's say I don't have 100 shares of Li Auto. If you know that you're wrong, you make sure to buy 100 shares when Li Auto breaks 40. Because the chances are for you to deliver your Li Auto at 40 is high because it just broke 40. So that's something that you could do. Try to sell a call price at a strike price that is really a resistance. But if that resistance breaks, make sure to buy it back. Because the momentum when that resistance breaks is going to go so fast that you might lose because so fast, you might end up having to buy Li Auto at 44, 46, 47. So what do you call that? The short squeeze effect. That is the short squeeze effect. Did that happen to the people in GME? Yes. Did that happen to the people in AMC? Yes. So there is a very strong risk when you sell a call and when you're not owning the shares. Covered calls lang ang tinuturo ko. I only teach covered calls. But let's say you're risky, you want to sell call without the shares, as long as you buy the shares automatically at the break of the strike, you are technically intact. At least, okay ka pa. You have shares to deliver. Let's say, I'll give you another thing. Let's say you think Churchill, CCIV, aka Lucid Motors. You have Churchill at 23, let's say, very low cost, below 23, even $20. You think Lucid Motors, Peter Rawlinson, he's the best company. He's the best car for breaking Mercedes-Benz chains in the future. Okay, you have to understand a few things. When you're selling a call, 100 shares do you have? Where do you sell call on Churchill? Look at it. Look at this chart. Where are the people trapped? 34, right? So selling a call at a strike price is not random. It's not, oh, maybe I'll sell Churchill at 30 because wala lang, I just like the number 30. Well, that's good, but it's a round number. That's why it could be a potential resistance. And it's also a 50% rally from the current lows of 20 and 18. You only sell a call at a strike price that is significantly higher than the current price. The current price is 28. So I tell you, maybe try to sell 10% higher, maybe 31, 32, 34. Those are valid strike prices. And then collect your premiums. Of course, obviously, the shorter the time span, the faster the decay. If you sell a call What is the chance that CCIV will hit 34 within 30 days? Perhaps you'll say maybe, well, the current price is 27, 28. For it to go 20% up in a month, I guess there's a chance of about 60%. Now, what if I tell you that what is the chance that CCIV goes 34 within 6 months? You'll say, wow, 6 months for it to go up 20%? That's a high batting chance. That's like 90% chance for it to happen. So that means when you're selling a call at a longer time frame, because it's like 6 months, the premiums that people are paying for is higher. So when you're selling a call significantly farther away, you get a better premium. 34. So let's say I have Churchill 100 shares and I can wait, meaning, you know what? I'd rather get $3 premium rather than $1. Anyway, I can wait for Churchill to go 34 within 6 months. You could technically sell a $3 limit at 34 or $2. Let's find a longer term call option. So this is the question. Do I have to sell call 1 to 2 months or do I have to sell call 6 months? Okay. If you want to get the best premium, of course, a 6 months is a higher premium versus a 1 to 2 months because the stock is in an uptrend, right? But if you think that within the next 2 months, this stock is going to go down, I better take advantage of the high expensive call options today because I can sell a call option right now at 34 and probably get $1.50. I might as well take it while I have just 2 months to expire or 1 month to expire. Because if Churchill Capital doesn't hit 34 or 33 within a month, that call option of $1 expires worthless, meaning it goes to zero. I pocketed my $100 gain and I'm not obliged to give my 100 shares to them. When is selling a call best? When the strike price is high and when it never really drops a lot, meaning it just sleeps. Sleeping zone. Meaning at 28, it just goes 27, 26, it just sleeps. It just sleeps 28 to 24. So that's the best. When you're selling calls and the stock is just choppy, you keep on just getting money every month. Sell call January, right now it's July. So sell call July, sell call August, sell call September. And you never have to deliver the shares. You just keep on getting $100, $100, $100. Give me my money, give me my money. You're just a tax collector. In this case, a premium collector. Isn't that a great job to get? Just collecting premiums? Yes, that's why a lot of people love writing options, selling calls, selling puts. Let me give you another answer how to make money. Let's say you're bullish on CCIV. You want to actually buy CCIV at $20. You actually have money. You have so much money, you have cash, and you think that I want to buy Churchill Capital at $20. How do I do that? Well, you wait for Churchill Capital to tank. You wait for a red day. Let's say it goes down 20% or 10% next week. If it goes down next week at 24 and you want to buy Churchill Capital at 20, what should you do? Sell a put the day that Churchill Capital is 24. Hopefully you get a premium of about $2 or $4. Let's say it goes bearish engulfing. That's the perfect time to sell a put at 20 strike Churchill. Because that time, the premiums would probably be $2 or $4. Somebody's going to give you $4. And what will you do with your $4? You collected the premium, right? If Churchill actually manages to go to $20, you get to pay for it. Sorry, let's say you get a strike, let's say Churchill Capital, right? So let's say the strike price that you got is 22, but you got a $2 premium. So 22 minus 2 is 20. If on July 30, Churchill Capital did hit 22 strike, you're obliged to pay 100 shares. So you're paying $2,200, but you got $200, so your actual cost is $2,000. So the lesson here is you sell a put on companies you really like, super out of the money, super low, and you sell a call on companies that you also like, but you have 100 shares anyway at a very high strike. Meaning for Churchill Capital, the best way is you sell put 22, you sell call at 34, you make money twofold, double side, downside and upside, you collect premiums two ways, and then you have 100 shares. What is that 100 shares for? If it goes up, you deliver. If it goes down, you actually buy the shares at 22, collect the premiums, it's fine. You collected premiums all the way. So what is that strategy called? It's called the well-known straddle. We called it, it's not my strategy. It's a well-known strategy by all options traders. And you want to do it if you can see a definitive support, a definitive resistance, like a real box. Does Churchill Capital look like a box to you? Well, from March till July, I think it's a box. The box support is 18. The resistance is clear at 34, 36. So keep on selling 34, 36, sell calls all the way till December, and sell puts all the way till December at $20. And I think you'll make money. That's how you can do it. Okay, you do it if it's a definitive box. Okay, there's a question. I'm holding CCIV warrants at $20. Pwede ba ito sa puts? No. As far as I know, warrants, I'm not so sure kasi I've never tried. All I know is that call options, put options, sell call, sell put works in stocks. O nga no, kasi CCIV, kasi I think of CCIV as a stock. So if you have CCIV warrants, I think that there is a risk that it goes down. Why? Why am I saying that there's a risk that it goes down? Because the warrants often will fall if the stock price falls. Since we're saying that may resistance ang CCIV at 29, 30, 34, the warrants will also have resistance. In other words, the only thing that you can do when you have warrants is to sell the warrants and then go to stocks. Yun. That's all I can say. That's all I know eh. I don't know how to do options on warrants. As far as I know, hindi ka makaka-sell call options on warrants. Okay, I'll answer a question. I'm holding Alibaba at 225. All right, let me tell you what to do. So we said that Alibaba is an asymmetric upside. Then again, Alibaba can also stay within a box, right? This is a box. Can you see that? There is a support at 200 and there is a resistance at 230. If you have a lot of position in Alibaba, let's say more than 100 shares, at least 100 shares. So you have $22,500 worth of Alibaba. What should you do? What you should do is you can sell a call option on Alibaba, perhaps at 240 or 230. And then collect maybe about $10 if you can, or $5 at the very least. Usually, pag mga options like these, ang hirap makakuha ng big yields. How do you compute the yield? The yield is the price that you got versus, actually, why don't we go straight to the options? Here's how you do it. I'm showing to you Alibaba. Okay, Alibaba options. So let's take a look at 237. So we're gonna sell a call. Let's say you've got Alibaba shares, right? You've got Alibaba shares, and you want to sell a call option at 237.5. How much do you get? It says here that you only get $2.50. So you have let's say you have 100 shares, you're gonna get $250 for the right to sell your Alibaba 237.5, or technically 240 na kasi 237.5 plus 2.5 eh. So if you're willing to actually collect $250 today for the obligation to sell your shares of Alibaba 237.5, it's okay. Anyway, you said you have a lot of shares, you want to really unload your Alibaba 240, okay na yon. So that's one way. Notice, you can keep on doing that every month. Let's say July 30 expires. So August 30, hanap ka ulit. Every month, just keep on selling calls. As long as you have 100 shares of Alibaba. Let's say you tell me you don't have 100 shares. Unfortunately, you can't do anything about it. You cannot do sell calls or sell puts if you don't have plans to sell 100 shares, or you don't have plans to buy 100 shares. That's the only difference of why option strategy works for the ones who have 100 shares. Okay? 100 shares. One contract is 100 shares. There's no half contract. There's no 1/4 contract, etc., etc. Okay? Let's continue. So charge point. Okay. So charge point right now looks high, diba? 86% up. So, 'di ba, you think na yes, electric vehicle is the future, but notice that everything is already high. So, I think that these $48 are really high. So, what if I just sell call, Nikki? What do I do? So, I'm not really saying that you cannot sell a call if you don't have the shares. But you have to be very careful, 'di ba? As I said, pag nag-break yung strike, buy back, buy the shares. So, sige, let's take a look at charge point. Let's say I don't have charge point, pero kate-katera si Nikki. Gusto niya mag-sell call sa charge point because she thinks it's gonna fall anyway. I think na maybe it's not gonna go $40. So what if I sell a call on charge point? Pwede naman, di ba? Okay, sige. So let's go to charge point and look at the warrants. Sorry, not warrants, the options, di ba? So you're selling a call, gusto ko mataas na strike, syempre, kasi I'm selling eh. So let's say I'm gonna sell a $40 call option within July 30. Feeling ko, hindi naaangat yan kasi 80% up na yan eh. Hindi na yan mag-120% up. Willing ako to take the risk. I don't have 100 shares of charge point, but I will still sell a call. Okay lang yun, basta marunong ka mag-buy back, mag-buy ng shares. So far, it says here that you can only get 60 cents. Bilangin mo, 60 cents over 40, I'm just getting $60 for a $4,000. Is it good? Technically, hindi. I said 5%, meaning kailangan $2. Hopefully $2. So wala. Wala kang opportunity. But let's say gusto ko pa rin kasi i-sell call yung charge point eh. Tingnan mo, the next month na lang, usually kung 60 cents yan, baka next month merong $1.50. Tingnan mo, kung talagang if you really believe the charge point is not gonna break $40 kahit next month, find a 2-month call option. Tingin ka ulit. O, click options, hindi July, August. Tapos strike price 40 pa rin. You want to sell at a high strike eh, di ba? August 20, so 2 months. Take a look at the option price. $1.20. Okay, willing ka ba to take $123, 3% yield? For some people, for them, pwede na rin kesa wala. Kasi feeling ko naman, charge point is not really gonna go beyond 40 eh. So, you do it. You do it, no? So, tonight, sell ka 1 contract, you get $123. And what is the risk? Where will you buy back? Where will you buy 100 shares? Para sure ka. August 20 pa yon, di ba? Okay, this is what you do. The Nikki technique is, ano yung high price? 36, di ba? Siguraduhin mo may buy stop ka ng charge point 100 shares sa 37 para may shares ka pambayad. Now, gagawin mo lang naman yun, magde-deliver ka lang ng shares sa kanya if charge point really breaks 40. So let's say ayaw mo 37, gusto mo talaga sigurista ka, break 40. Di sa 40 ka mag-buy stop. Kung saan yung strike mo, dun ka technically, magde-deliver ka na ng shares eh. August 20 na po, sir. You are obliged to give me 100 shares. So, dapat, mga August 15 or August 13, nanginginig ka na dapat. Oh my God, wala akong 100 shares na charge point. Baka ma-call ako. Bibili ka ng shares. Bilhin mo, kahit sa 40. Anyway, nakakuha ka naman ng $1, di ba? $1, $1.20. Bayad ka na ng 100 shares. Okay na, covered call ka na. Game, pwede ka na. Are there people who really sell calls and then wala silang 100 shares? The answer is yes. I think there are people. Pero, disiplinado yan. Kasi pag nag-break yung strike price, deads ka. I'll give you an example. What if, tangengots ka, nag-sell call ka ng ASTS sa 12, nag-16, patay ka. Wala ka bang 100 shares ng ASTS Space Mobile? Kasi 10, di mo naisip na magfo-14, no? Let's say, kate-katera ka, hindi ka nag-iisip. No choice ka. Bumili ka na ng 100 shares sa 13 kasi pagdating ng July 20, pag naka-sell call ka sa 12 or 13, you are obliged to give those shares. Loss mo na yon kasi nag-sell call ka eh. Katangahan mo yon, nag-sell call ka. Sample, I'll give you an example. Why is it risky to sell call when you don't have 100 shares? What happened to Intelia? What happened to Intelia? 60% up. Sabi mo hindi mag-100% Nikki this month. Nag-100%. Buti na lang we said aangat. We never said a target. We were bullish on biotech, right? We were saying mukhang okay yung mga CRISPR, Editas, genomic sequencing, gene editing, blah, blah, blah. Naka-jackpot. Boom. Meron tao, there was somebody on the other side na squeeze. Usually, bakit siya na-squeeze? Because Intelia had a phase 2, phase 1 study that showed the breakthroughs on genetic editing. Diba? 90, nag-180, nag-100% up within the month. Dead ball, yung nag-sell call. 'Di ba? Dead ball siya. Okay, let's say, ito yung pinaka-risky na hindi ko tinuturo, but sige, tuturo ko. Intelia right now is $170. You feel lang, hindi na yan mag-100% up again kahit na sobrang ganda ng news. All the good news has been priced in. I want to sell at $240. Let's take a look. Is it worth the risk? Tingnan mo muna if the options are really spiking. Because usually, when the stock price is going up, the call options are gonna spike up like no tomorrow. So go to Intelia. This is the risky so ingat lang. If mali ako, you have to buy the 100 shares. Pwede ka mag-gamma squeeze, lalala. So let's say you think July 20, end of the month, Intelia is not gonna hit 50% higher. Tapos na yan, 240, mapapabenta mga tao dyan. July 16, ano na lang yan? 14 days to go. Siguro naman in 2 weeks, hindi na yan mag 50% up. Sa tingin mo, di ba? Okay, take a look. Magkano yung option? $2. Because so many people also think that it's not gonna go 240. They're just gonna give you $2 or just 1% yield. Kung payag ka na sa $200, okay na rin. Kaysa wala, di ba? Kasi the chances of Intelia going to $40 is super small. So nobody is also willing to pay the premium. Now, tingnan natin yung $200. Siyempre, mas mataas yung call option na ibibigay sa'yo, di ba? Kasi mas malapit yung, obviously, 200 is cheaper and lower than 160, di ba? Mas malapit yun than 240. So take a look again. So may konting utak din, guys. May utak, 'di ba? Hindi man pwede basta-basta na lang. You make money with your brains pa rin. July 16. Okay. Pag $10 yan, payag ka? Pwede na rin, 'di ba? 210 yon, $6. Okay. So they're giving you $625 and you have 14 days that Intelia is not gonna go break 200. Let's say you want to take the risk. What will you do? You sell a call. Kailan ka bibili ng 100 shares of Intelia? Kailan? When? You only buy Intelia 100 shares when Intelia breaks 200. Yun. Pero I think manginginig ng ibang tao when they see Intelia go 180, right? Kasi 200 na hit eh. So may mga ibang tao thinking babalik yan ng 200. So if you think na I think that the people who have $80 are so happy they'll sell at 200. You want to take the other side, you can do that. I'll tell you one thing, sample. A lot of the Awesome 10X have PAC bio. So I'll give you a concrete example. We were thinking that PAC bio at about 25 and 26 was really gonna go up. Of course, we didn't know it's gonna go 36 within a month. We just felt, well, at these levels, it's gonna rally because the entire genomic space is gonna go up. We were also bullish on PacBio, Bingo Nano, Bio Nanogenomics, even healthcare like Teladoc because it was oversold. We liked the sector, CRISPR, and Vital, so we believed in it. So some people bought the call option of PacBio, and they have the $26 call option. That means by July 20, I think July 16, 14 days na lang, they have two options. Either they have to buy 100 shares, give 2,600, right? So let's not talk about theories. We did it eh. We bought a call option on PacBio, $4 we paid, right? At 26, diba? July 16 is gonna expire. What happens? Today, PacBio is $9. You have two ways to handle it. If you think that this PacBio at 36 is gonna be going down to $30, your call option will become lower. That's why, habang 36 pa yan, sell mo na yung call mo. You make money na. Yung $4 mo dito, naging $9 na yan, out ka na, you made money. Now, what's the next thing to do? if you think talaga that PacBio hindi naman naangat ng 40 or 50, baka bumaba yan, what's the proper thing to do? Sell call ka sa highest, dito sa 40 ka, pumila ka sa 40, wag sa bababa. So take a look at what the options that they are willing to pay you if you sell call on PacBio. Maganda yan. Right now, biotech, malakas eh. The best time to sell a call option is when everyone is bullish about it, right? Siyempre, mataas yung call option na ibibigay sa'yo. Mataas yung premiums. When you're selling a call, siyempre gusto mo mataas. Hindi ka magbebenta ng mababa. That's the reason why we're selling NEO calls or FUV calls or PacBio calls or Intelia calls, if ever, or Editas calls, because mataas yung premium, or ESTS calls. So, PacBio. Take a look at the PacBio. PacBio. Go to the call option. The call option is the ability to buy PacBio at 40 within, let's say, this month, 1 month expiry. Ande, July 16. So you think, you know, it's not gonna go 25% higher after reaching 36. A lot of people would probably take profits already. Okay, so take a look. How much is the premium at 40 call? Wala na. Nothing. 20 cents. If it's less than 5%, don't bother. If you're just getting $20, wag na. No deal. So when you're doing your sell calls, utak pa rin. Take a look at the yield. How much are they willing to give you versus the strike? If it's 5% and 10%, game yon. Usually, usually. So yon. Okay, so you really have to check those prices. So let me give you some ideas, no? This is an IPO, too simple. Too simple is an IPO that went 100%. Okay, sige. Let me answer because somebody's asking, hello, I have Arcimoto. Can we discuss the call option strategy for Arcimoto? Okay, sige. Let's talk about Arcimoto. Okay, yeah, Arcimoto is also part of my sell call chart example. So let me give you the exact, no? Let's talk about Arcimoto because it already is extended from 7, it went to 17, right? 18, up 139. Okay, from the chart, it tells you there's a resistance at 20. So let's say sigurista tayo. Sige, mag-sell call tayo ng FUV sa 20. Hanapin mo yung, again, do the same thing. Go to FUV, click options, strike price 20. Let's say this month, July 16. Okay, let's take a look. 45 cents. Mababa lang. So let's find na lang next month na lang. Kahit na next month na lang, sa August ka na mag-sell ng call. Kasi mababa na yung 45 cents, like 2% yield lang eh. So baka maka $1 ka pa next month. So change the date from July, make it August. Strike, make it still 20. And then August 20. So you've got 1 month. So $1.50. Ito pwede. 7% yield. So we have Arcimoto, sell the calls at 20 at 1.5 limit. Meaning if I have 100 shares of Arcimoto, what should I do? Sell 1 contract FUV, take that $150, and then I deliver my shares. If FUV hits $20 by August 20, what am I obliged to do again? Repeat. You are giving him 20 price. Is that a good deal for you? Yes, because if you sell FUV today, you're just getting it at $15. But if you wait August 20 and get that premium today, you got $1.50. So you only do that if you really believe that at some point in time, well, you know, even if FUV goes down to 12, I'll get that $150 today because that $150 is gonna buy me Arcimoto 10 shares. 10 shares pa rin yun eh, Nikki. Let's say I have 5 contracts. $750 yun na. I got $750 free money for selling a call option, which is gonna be my bala, my bullet, if FUV indeed fell mga $12 within next 2 months. You get the thinking that I'm saying? Nakukuha mo na yan eh. When you sell a call option, pasok na yung pera sa buying power mo. That's the reason why it's nice to sell a call. Pasok yung buying power dyan. So if this is not something that you knew, congrats, you're an awesome 10X. Now you know. Okay? Now you know. Magugustuhan mo mag-sell call. Basta may 100 shares ka. Yun lang. Kailangan may 100 shares ka. Okay.
Katikatera si Nikki, nagsisell call sa too simple. Wala naman siyang too simple. Yes, wala akong too simple. Wala akong TSP, kaya hindi ko gagawin yan. But, let's say, gusto nyo maging katikatera na naman. Feeling genius. Tingin nyo, too simple is not gonna go $100. Usually kasi, IPOs, because it's a blank slate, take a look at the volatility. When a stock moves down 20% in a single day, tingnan mo it went $80, biglang $60. Dahil ang bilis ng drop niyan, mataas yung implied volatility. IV is implied volatility. Okay, there's a question. Let me answer first. Does the unrealized P&L even matter for sell puts and calls? No, it doesn't matter. Because the sell calls and sell puts, you received $1. The problem lang is, syempre, if the stock price goes up and up, ay sayang, you could have gotten 100 from $1, it went $1.50. Ay sayang, you could have gotten $150. But kaya nga sinasabi ko, when you get a 7% yield, yun na yung profit mo. 7% yield, $150. Sorry ka na lang kung may nagbayad ng $2, $200 pala. That's the only difference. You never lose on a sell call and sell put. Even if the unrealized P&L goes up and down, it has no meaning. Kailan papasok yung sell call? Automatic. The moment you sell call today, pasok na yan sa buying power mo. Now, the sell put, the problem with sell put, guys, is that nauubos yung buying power mo. In a sell put, pasok yung $100, but then again, you're obliged to pay if that strike price hits. So yung sell put, ubusan ng buying power yan. If you have $10,000 today, pero nag-sell put ka sa CCIV at 20 strike, IBKR will automatically assume that you're paying $2,000. Babawasan niya ng $2,000 yung 10K mo na buying power. So magiging 8,000 yung buying power mo. When you're selling a put, you're obliged to pay 100 shares. When you're selling a call, you're obliged to deliver. So you're giving 100 shares. Baliktad. Okay? So I hope you understand. Sell put, ubusan ng pera yan. Pag wala kang cash, sorry, hindi ka pwede mag-sell put. Wala kang buying power eh. Sell put might risk you to pay the shares. Pwede ako mag-sell put ng $180, let's say sa Alibaba. Let's say, 220 nga. Sabihin natin, $200 para sa support. Tingnan natin kung magkano ibabayad sa akin. Actually, maganda mag-sell put. Let me give you an example. Try nyo mag-sell put sa Roblox sample. Kasi binabagsakan Roblox, di ba? And let's say ganito, balik na rin natin yung opinion natin. Let's say, tingin natin uptrend yung mga solars. Maction, hindi ako nakabili ng marami ni Kinong nasa $15 to. Paano ako How will I get, I can't speak in Tagalog. I have to speak in English. Some people might not understand me. What if I like solars long term and yet I missed on the great bargain hunting during May and I still missed during June? What do? I want to buy Maction, Nikki, at $15 or $16. Here's how you do it. Look at Maction. Take a look at the options. The more volatile it is, the better. But actually, Maction is not that volatile. So maybe Sunrun. Sige, let's go for the more volatile. You want to buy Sunrun, di ba? Okay, we like to buy Sunrun at $45, let's say. So you have to sell a put at $45. And then, siguro sa July, wala masyado yan. So try the August. 45. So sell a put 45 August. How much money do you receive? $1.75. So it's about 3%, 3 to 4%. If you sell a put on Sunrun, they give you $175 today for the ability to buy Sunrun at 45. So meaning, end of the day, babawasan, automatic yan. Your buying power will be reduced by $4,500. Kasi 45 times 100 eh. $4,500. So negative 45 plus 175 equals negative 4,325. So your buying power gets reduced by negative $4,325. Let's say by August 20, Sunrun is above 45. Let's say it's 46. It technically expires. So you never got to buy Sunrun, but you got $175. So sell put is an ability to buy the stock at a discount perhaps a discount. I mean, it is of course the chance. I'm not saying that you will be sure that you can buy. The chance to buy it at a discount, but while you're waiting, you got paid. Can you imagine? You're getting paid $175 for the chance to buy Sunrun. Isn't that great? Now, think about it the other side. Who do you think is paying that $175? Okay. That person paying that put option is buying an insurance. They paid you $175 so that whatever happens, if Sunrun went $40, sure ako that Nikki is gonna pay $45 because the strike price is $45. So make sure that when you make a strike price, when you're selling a put, you're a determined, highly conviction buyer that Sunrun at 45, I'm so in love with it, I'll buy it at 45 even if it goes 40. I promise you I'll pay it 45. That's what it means. You only sell a put if you are a high conviction buyer. You only sell a call if you're a high conviction seller. Or if you're not high conviction seller, make sure you have those 100 shares. You're gonna give it to them. Okay? If there's more questions, just keep asking because it might not be in my example. Does selling a call affect your buying power? Yes. Selling a call will increase your buying power because you received the money already. What is the difference between buying a call? Okay, when you're buying a call, your risk is it expires worthless. Kasi, example, I buy a call on Sunrun. I buy a call option on Sunrun on July 16, 2021 at $50. If Sunrun is not $50 by July 16, that is worthless. It goes zero. Buying a call option is very risky. Selling a call option is also risky if you don't have the shares. So, there's a lot of difference between buying a call and selling a put. Buying a call option is telling you that you are the one paying, right? Buying a call, you are gonna risk already. Example, this one. Let me tell you an example. Sunrun. Let's say you are buying a call on Sunrun. You're bullish on Sunrun, pero you can lose money if you buy a call na sobrang high price. Okay, the current price of Sunrun is 55. So technically, may $10 intrinsic value yan. 'Di ba? Kasi 55 ngayon Sunrun eh. Oh, you're paying 11.50. Lugi ka. You're paying 11.50. Sunrun on July 16, let's say. Oh, di nagbayad ka, 'di ba? Magkano Sunrun ngayon? Let's go to TradingView. Sunrun is 55. Let's say today is July 16. The price today is July 16. The price is 56. Okay. So 56 minus 45, intrinsic value is $11. So technically, if you buy this call option of Sunrun, nagbayad ka na. 11.5 times 1 share times 100, 1 contract times 100 shares. I paid $1,150 to buy $4,500 of Sunrun. So what is my real cost? 56.5. What's the difference between paying 56.5 through Sunrun here versus just buying 56.28 through here? Gets mo? If you really like Sunrun, bilhin mo na lang yung stock. Why are people buying a call option? They bought that call option when Sunrun was not yet 56. They bought the call option that Sunrun is gonna hit $50 or $40 and something when the Sunrun stock was still at 43. Sample, I'll give you an example. Let's say Sunrun, hindi pa 62, di ba? 56 pa lang. Let's say super high conviction ka. Nikki is wrong. Sunrun's gonna go $62 within next week. Sure na sure ako. What should you do? Sure ka na angat? $6 up yan? You look at the Sunrun call option at 60 strike. Kasi out of the money pa yan eh. The people who buy call options are usually the ones who are buying out of the money. Malayo pa. The strike price is 60. Sunrun. Options. 56 ngayon, di ba? So, titingnan mo yung out of the money. 60. Mura pa yan. Nasa mga 50 cents lang yan. Or, hindi, mahal pala, $1.70. Ang mahal. Actually, ang mahal niyan, mapapasell call ka niyan. Ang mahal niyan eh. 3% yield. If I have Sunrun, I'll sell call there kasi willing ako to sell my Sunrun. I'm willing to give my shares, 100 shares at 60, and then I'm willing to take that 3% yield. So isa-sell call ko yan. Mahal masyadong call options, meaning sobrang daming. It means that people are so bullish on Sunrun that they're willing to pay a $1.70. They're betting $1.70 that Sunrun will hit $60 by July 16, 2021. Do you know what happens when they're wrong? That Sunrun doesn't hit 60 by then? Let's say it's 59 on that day. This expires worthless. It goes zero. It goes zero if it never hits that strike. Okay, so know that. Okay, there's another question. Can I close a sell call option before expiration date if I don't want to deliver my shares? Yes, you can. To negate a sell call, you have to buy a call. Yes, you can if you don't want to deliver your shares. But buying a call back gives you a risk. I'll give you an example. Let's say I sell a call on Sunrun at $1.70. Sunrun from July 2 to July, let's say next week, July 9, Sunrun went 59. The current price of Sunrun is 56, but Sunrun is 59 next week. It means that there is a higher chance that this call option will not expire to zero, right? Because it could go 60. It could really break 60 by July 16. Thus, the call option of 1.7 could be 2.5 by then. It could even be $3 by then. So, the people who bought the call option 170 can sell it at 3. The one who bought. If I sold the call at 170, I am at risk. Either I pay, so I got 1.7, but I now have to pay at 3, so I lost $1.30. But the happy thing that I do is, whoops, I have 100 shares of Sunrun. I'm going to give you my Sunrun shares. So that's it. Okay. So I hope that you learned something. I'm going to give you just examples of companies that I think are are probably going to be good sell calls. So Roku, after 60% up, the sell call option here would be somewhere in the $500 zone, the all-time high zone. You only do that if you have 100 shares of Roku. Else, if you don't have it, buy it on the break of 500. Okay. Twilio is so strong. So super strong, like 40% up. If you think that this $460 is gonna be a good sell call price, so just take a look. Usually, good strong moves, strong run-ups would have high IVs. IVs means implied volatility. Because they have a high implied volatility, you have a way to sell call at a good premium. Now, worst case, if you sell a call and then you don't have shares, buy it back on that strike price before the day expires. A few days before it expires. Fiverr, it's super strong. So usually, everyone is very bullish. To sell call at a high price, you have to be the contrarian eh. If you think about it, you have to be the contrarian na after a 60% rise, I don't think it's gonna go $350. That's why I think at 320, I'm gonna sell a call. That's you. That's what a sell call person is. Advanced Micro Devices, example, uy, good news, Xilinx and AMD, they're married already. Okay, the question is, do you think the news is priced in? If you think that $110 is where Advanced Micro Devices is probably gonna top, sell a call at 110. Ganun lang. And take a premium. NVIDIA, very strong. Everybody loves it. The fact that everybody loves it, take a look at $900 sell call on NVIDIA if you have shares of NVIDIA. Because that allows you to sell your shares at a high price, way higher than today's price. And it allows you to cushion yourself if NVIDIA goes from $800 to $700. So that's why you're selling calls. I would only sell call. The awesome 10x way is if I have 100 shares of the company. Because I don't like to be naked short. Roblox, example. I'm scared, example, if Roblox will go $80, what do? I can sell call at 100. If I have Roblox shares, I'll sell call at 110 or $100. So really at the resistance. Okay, Unity, you have 100 shares of Unity. What do? Again, let's just repeat. You sell call at 130. Find the strike price that is very high, sell call there. Palantir, where's the strike price to sell? 30. Where's the sell put? 20, 22. So sell puts 22, sell calls 30. Fintech, everyone likes brokerage firms, like, right? Tiger, Futu, all of them. Where will you sell calls if you have Tiger? Perhaps 30 or 34 or 38. Where will you sell puts? Perhaps $20. Futu, everybody likes it, right? But you want to sell call at 180 or 200 and then sell puts at 120. Okay, AST Space Mobile, this one, I would not sell a call, but if I would sell a call, probably at $18 or $17. So, or some of us even, do you know how stupid, how weird we were? We sold call at 25, as in sakto 25 ASTS. As in we think na, oy, ang happy ng market. Sige, sell call tayo sa ASTS at 25. And some of us also sold at 20. Syempre, lubos-lubosin mo na, magsisell call ka na lang din, taasan mo na. If when you're selling a call, sell at the highest price that you can. Global Star, di ba, high $3. If you're gonna sell this, I don't know if you can get a good premium at $3. But when it was rising to $2, I think you could have sold at $2.40. So you only sell call on a green day. Ito, example, Editas, everyone's happy here, di ba? If you're gonna sell call, where? Take a look here, $68. So if I'm gonna sell a call on Editas, it has to be $70. I'm gonna give you my shares at 70. Give me the premium now. Beam Therapeutics, all-time highs. That's why a lot of people are afraid. If they don't have Beam shares, di ba? Let's say you have Beam shares. What should you do? Sell call, 150. Taasan mo na. 20% above. PacBio, sell call, 40. Pintuato, sell call at 150. Hindi pa, okay, sorry. With Pintuato, here's the problem. This has not risen. So even if you wanted to sell call at 140 or 150, mababa yung premium. Mababa premium yan. Even if you want to sell call at 170. Nonetheless, if you have so many shares of Pintuato, you can. Like example, kanina, di ba? Alibaba, we said, mababa lang yung premium. Chances are at $1, 150, I think the only premium that you'll get is about $1 to $2. So yun lang. So yung downside mo naman is that Pintuato is just $110. So hindi rin naman mababa. When there's no volatility, there's not much to gain on sell calls and sell puts. So yun, to end our speech, buy shares in good companies, schedule cost averaging on them. This will remove you from the dramas of the bulls and the bears. So I have a lot of examples there, but I don't think I have time anymore. So yeah. So the sell call and the sell puts are abilities to buy shares in good companies or sell shares in the companies so that you can schedule your cost averaging on them. By selling calls and selling puts, you always get a monthly income by collecting the premiums, and you're happy anyway. You're delivering the shares at high strikes, you're buying the shares at low strikes, so win-win. Okay? There are no options for pink sheets. There are no options for so I'm sorry, you can't do pink sheet options. Call options are only done for NASDAQ and New York stock listed. So yeah. That's the only thing that's the only risks. Now you can't do sell calls on an ABML because it's an OTC. You can't do sell puts on them. But we have ideas naman that are all listed. Sample, I'll tell you an option that you can do. IHANG, some people are scared. IHANG at 41, what should I do? Should I sell it? Okay, sell call ka na lang sa 54. Baka makachamba ka pa, or 50 or 45. Sell a call very high. Anyway, we're long-term here. So yun. Hope you learned something. Goodbye. Thank you. Enjoy. Have a good week.